Hey everyone, and welcome to this explainer. Today, we're diving into the explosive growth, the inner workings, and the future outlook of the iShares Semiconductor ETF, better known by its ticker, SOXX. Now, if you've been keeping an eye on the markets, you already know that semiconductor chips are basically the undisputed engine of our modern economy. But figuring out exactly how a targeted fund like SOXX capitalizes on this massive structural shift, well, that is absolutely fascinating.
Just look at this number, 104.48%. That is a year-to-date net asset value total return as of June 2026. We're not just talking about a mild market beat here. We're looking at triple-digit growth in roughly half a year. That is wild. So that jaw-dropping number leads us straight to the million-dollar question. Can this semiconductor boom actually continue to crush broader indices, like the S&P 500, for the rest of 2026? To figure out if this momentum is truly sustainable, we need to look under the hood. We're going to dive into the structural environment, the fund's precise rulebook, and those specific heavyweight holdings driving these massive returns.
Here's our quick roadmap for today. Number 1, the AI Semiconductor Supercycle. 2, unpacking the SOXX ETF. 3, heavyweight holdings driving growth. 4, crushing the broader tech sector. And 5, future forecasts for 2026. Let's get right into it. Section 1, the AI Semiconductor Supercycle. We'll be looking at the macro forces fueling the demand. Okay, let's zoom out and look at the big picture. The Motley Fool points out that the semiconductor sector historically moves in boom and bust cycles. But when the whole structural environment shifts, that's when the leaders can see massive returns for years. And that is exactly what's happening right now with the AI revolution. The really crucial piece of the puzzle here is the timeline. Back in 2024 and 2025, the market was entirely focused on building that initial AI infrastructure. But now, in 2026, we've shifted into full-scale adoption. The pie is getting significantly bigger. It's not just one or two pioneers making all the money anymore. Billions of investment dollars are flowing to these next-in-line semiconductor companies, powering everything from cloud computing and autonomous systems to those giant data centers. Moving on to Section 2, unpacking the SOXX ETF. Let's look at its methodology and eligibility rules. Before we get to the individual stocks, you've got to understand the ETF itself. SOXX is designed to track something called the PHLX Semiconductor Sector Index. Basically, this index is built to measure the performance of the 30 largest U.S.-listed semiconductor companies, so it gives you highly targeted exposure to the absolute giants of the industry. But you don't just get into this club by accident. To even be considered for this elite group of 30, companies have to pass some really strict tests. First off, a minimum market cap of $100 million. But size isn't everything, right? Liquidity is absolutely vital. A stock has to have traded at least 1.5 million shares in each of the last 6 months, have a minimum trading history of 3 months, and be eligible for U.S. options trading. This ensures the ETF is built on a rock-solid foundation of highly active, established players. Now here's where it gets really interesting, how they actually weight the fund. It uses a modified market cap weighting system. To stop one massive company from completely taking over, they strictly cap the top 3 stocks at 12%, 10%, and 8%. Every other stock is capped at a maximum of 4%. If a stock goes on a crazy run and busts past its limit, that excess weight just cascades down and gets proportionally redistributed to the smaller guys in the index. It's a brilliant balancing act. It prevents a single hype-driven mega-cap stock from artificially skewing your risk, giving you a much healthier, broader representation of the whole sector. Up next, Section 3, Heavyweight Holdings Driving Growth. We are spotlighting the top 5 engine room stocks. All right, take a close look at this ranking because these are the top 5 holdings driving SOXX as of June 2026. This is the engine room. We've got Micron Technology, Advanced Micro Devices, and Marvell Technology taking up those heavily weighted top 3 slots. They are actually sitting ahead of massive household names like Broadcom and NVIDIA. Notice how Micron is pushing right up against that 12% maximum cap we just talked about, and AMD is right on the heels of its 10% limit. These specific companies are literally the engine powering those triple-digit returns we saw earlier. If we zoom out just a little bit from those individual tickers, the fund's sector allocation tells a great story. It is heavily tilted, with 81.57% in pure semiconductors, the guys actually designing and making the chips. But crucially, just over 18% is allocated to semiconductor equipment manufacturers. These are the companies supplying the incredibly complex tools and raw materials needed to make the chips. Think of them as the ones selling the picks and shovels for the AI gold rush. Let's spotlight a few of our heavyweights, starting right at the top with Micron Technology.
They command nearly a 12% weight in the fund. According to data from the Motley Fool from early 2026, Micron had incredibly already banked an 18% plus gain right out of the gate this year. That kind of massive performance from your top holding heavily contributes to the ETF's overall run. Right behind them is AMD, coming in at roughly a 9% weight. Remember how we talked about that shift from initial infrastructure to full-scale adoption? Well, AMD is the poster child for a next-in-line AI beneficiary riding that exact wave. Just like Micron, they also posted a stellar 18% plus gain early in 2026. And then we have Broadcom, holding down almost 7% of the fund. Seeing Broadcom featured so prominently alongside Micron and AMD is real proof that the biggest winners in this massive structural shift go way beyond just the initial NVIDIA hype cycle. The growth has really broadened out beautifully across the sector, pulling all these major players up with it. Section 4, Crushing Broader Tech Sector. Let's do a head-to-head performance comparison. So what happens when you combine this highly specific mix of chip makers and equipment suppliers? Well, looking at the official annual shareholder report from BlackRock, it propelled the SOXX fund to a staggering 76.05% one-year return as of March 2026. BlackRock specifically points out that this was driven by insane demand across AI, cloud computing, and data centers, which gave these firms massive pricing power. Let's put that into perspective. When you stack that 76% return up against the broader MSCI USA index, which returned 17.74% over the exact same period, it is night and day. It visually hammers home just how overwhelmingly dominant this targeted semiconductor exposure has been. It didn't just beat the broader technology and US market indices, it completely crushed them. Finally, Section 5, Future Forecast for 2026. We're going to analyze some dueling analyst outlooks. As with anything in the market, we've got two very dueling outlooks right now. On one side, you have the Motley Fool. They are super bullish, strongly predicting that SOXX will just keep beating the broader market, including the S&P 500 and the NASDAQ 100 throughout 2026, all thanks to accelerating infrastructure spending. But on the flip side, StockScan analysts are waving some red flags. Looking at the short-term technicals, they are actually forecasting a potentially severe 30-day drop down to around $422. That would be a massive 29% haircut. But wait, it gets even more fascinating when you look closer at StockScan's own data. Their overall technical analysis actually flashes 12 buy signals versus only 3 sell signals. However, they're calling out the RSI, the Relative Strength Index, which basically measures if a stock is overvalued or undervalued based on recent price speed. And they say it's currently overbought. That means a correction might be right around the corner. But if you look further out at their long-term forecast, it points straight back up, projecting an average target of $528 by 2035. Ultimately, if you're buying the bullish argument, it all rests on this one key observation from the Motley Fool. The physical build-out required to support full-scale AI adoption is a multi-year cycle. This isn't just some flash in the pan. We are talking about billions of dollars in sustained, ongoing investment flowing directly into the specific companies held by this ETF. So here is the big question I want to leave you with. As AI shifts into full-blown adoption, and given the massive returns we've already seen from heavyweights like Micron, AMD, and Broadcom, will the SOXX ETF continue its historic run of totally crushing the broader market? Or are those technical indicators right, and an inevitable short-term cooldown is just waiting to happen? Keep a very close eye on those top holdings, because as they go, so goes the entire fund. Thanks so much for joining me for this explainer, and keep learning.